What's going on, PFR Nation? This is Kevin Lau, your host of the Planning for Retirement podcast. And first of all, happy Thanksgiving to everybody. I'm recording this the week prior to, but I believe Thursday next week, this episode will be coming out. So happy Thanksgiving. I hope you all are enjoying time with your family, your loved ones, enjoying some football, and just overeating, and going into a food coma. So that's what I'll be doing. But today we're going to be talking about end of year tax planning. We are in review season for our practice. And with our review season at the end of the year, we're hyper focused on tax planning opportunities, not only for 2024, but really looking into the future. Because the difference between tax planning and tax preparation is that tax preparation is really a reactive process. The year ends, the year starts, you get all your 1099s, you start to collect them, put them in a file, and then you hand them to your CPA. And then you say, hey, how do you minimize my taxes that I'm going to pay for the last year? Well, there's not a lot you can do at that point in time. Sure, you can make some IRA contributions, some Roth contributions, et cetera, but there's not a whole lot of strategy involved with minimizing taxes for the previous year. But there is strategy involved. There are things you can do, not only this year, but in years going forward, to ultimately mitigate your lifetime tax paid. That's really what we focus on with tax planning, is really looking at our client's picture, looking at their financial projections, looking at the projections of their beneficiaries, and trying to figure out, how do we minimize lifetime taxes paid and ultimately lifetime taxes paid by your beneficiaries? That's what tax planning is all about, okay? And so it's an ongoing process. It's not an event. And so what we're going to focus on today is really talking through, what are some of these things you could be thinking about? What sort of strategies can you really deploy, not only for this calendar year, but really in years going forward? And then also thinking through what the timing is in terms of when you might implement those strategies, because not everything I talk about today is going to be implementable right away. This might be something that you're like, oh, hey, when I retire in 3 years, that's when I'm going to implement this. Oh, hey, this is a great opportunity I can implement this year, and then maybe continuing on that process going forward. So you need to really think through how this applies to you and your unique situation, because again, at the end of the day, financial planning is personal, and you want to make sure you are implementing things that are going to move the needle for your family, that are going to improve your situation. Because it's very easy, to get lost in the rabbit hole of YouTube or online and just, read all of the content and read everyone saying, do this or do that. And it's very, really difficult to really figure out, hey, how does this apply to me? And that's why I'm talking to you, PFR Nation, those of you that are in that 50 to 60 plus range, that have already saved. Most of you have already saved over 7 figures. Some of you are even approaching 8 figures. And you're just trying to figure out, hey, when can I fire my boss? When can I make work optional? How do I minimize my lifetime taxes paid? And ultimately, how do I maintain financial independence and pass on my assets tax efficiently to my beneficiaries? That's who I'm talking to. And so if that fits you, of course, make sure to subscribe to the show. That is going to help you in your planning for retirement journey, but also to sort of qualify that, hey, you know what? If you're not in that sweet spot, you could probably still learn something. Okay. If you're 45 and you're sort of in this early retirement path, sure, you could probably learn something. If you're 75 years old, absolutely, you could probably learn something too. But a lot of the strategies that we talk about are in that sweet spot, the 50, 60 plus range, that are in those financial parameters that we mentioned. So it's not really for the underachievers. Y'all are really the overachievers. Now, it is Thanksgiving. So before we get into the content, of course, I wanted to talk about what I'm thankful for, right? Because that's sort of the cliche thing you do on Thanksgiving. And there's a lot I'm thankful for, but I would be remiss if I just didn't say I'm thankful to live in America, right? I just sort of think through the last few weeks, what's transpired. It was a very polarizing election. And I did an episode on the Trump versus Harris tax policies. And truthfully, I was pretty civil about it. A lot of you reached out to me like, oh, because I asked you, hey, who do you think I voted for based on my Trump versus Harris podcast? And so a lot of you are like, oh, you were pretty neutral, but I think you did this. But ultimately, I could have hammered either candidate. I could have openly said, Trump is terrible or Harris is terrible. And you know what? I wouldn't go to jail because we have the First Amendment, the freedom of speech, freedom of religion. Okay. I'm so grateful that we live in America where we have these freedoms, because try that in China, try that in Russia, try that in, North Korea. You probably end up in jail, truthfully. Okay. If you're speaking out against your politicians. So I'm thankful to live in America, and I'm thankful we live in a democracy. And regardless if you like Trump or not, he is our new president-elect, and he is going to be extremely busy over the next several months getting his cabinet ready, getting his people in place. And so regardless of where you fall in the political aisle, my plea to you is that just remember, we do live in a democracy, and Trump was president from 2016 to 2020. He did not turn into a dictator. Okay. We did not become a dictatorship. All right. So we're still a democracy. The last time I checked, and we had another presidency from 2020 to 2024, and we're also still a democracy. So I'm very grateful for that. Of course, I'm grateful for many other things. I'm grateful for my family. I'm grateful for all of you listeners. I mean, listen, without you, I probably wouldn't do this podcast, truthfully, because, with my business where I am, it's like, I don't necessarily need new clients. So, I mean, sort of this argument of like, oh, I'm going to do this podcast to just, really bring on a bunch of new business. It's like, that's really not my motivation. My motivation is I enjoy doing this. I like teaching. Of course, this is what I do for a living. I've been doing this for the last 16 years, helping people in some capacity prepare for and execute a successful retirement. And so ultimately what I like to do is just sort of talk through some of the things that have helped others, because now some of these people that we've been helping for, 16, 10, 5 years, there are things that I've learned now that I've been in practice that long that I can pass on to you, PFR Nation. And that's really what makes this fun, because ultimately the interactions I have with you all, I've heard from a lot of you over email, reaching out to me, commenting on the YouTube. And by the way, follow the YouTube if you're not already, because not only are we doing the podcast video form, which you can see my 4-day beard going on here, by the way. So that is right. I did not forget to shave. All right. I went to Florida last week, going to visit some clients, and I was driving home and I'm like, it's November and I live in Tennessee. Of course, I need to grow a beard. So I'm 4 days in. I'm still sort of on the fence of whether or not I'm going to go full throttle. I haven't had a full beard since senior year of college. And my wife is not really, I don't know if she's really a big fan. So, and I've got a few more grays on my beard that I can already tell are popping in relative to what that looked like senior year of college. So anyhow, yeah. So Thanksgiving, happy Thanksgiving to all of you. So, all right. So we're going to be talking about tax planning tips end of year. I've got a list of things that I want to talk about. So I'll probably follow this to some degree, but I might kind of jump around here and there based on certain topics. But, without further ado, why don't we kind of kick things off with really setting the stage with contribution limits and really the low hanging fruit, 401ks, IRAs, 403bs, defined benefit, defined contribution, all of these different rules in terms of when you can contribute, how much you can contribute, and then even some really exciting changes for 2025 in terms of catch-up contributions for those of you that are turning next year between the ages of 60 and 63. Again, you must be turning that age. So you can't be 63 in January, then in February you turn 64. You're not going to qualify for this special rule, this special provision that begins in 2025. So yeah, why don't we start there? Let's maybe start with deadlines. Okay, so deadlines for 401k contributions. So when I'm talking about 401k contributions, there are several different, contribution sources. You have employee contributions, you have employer contributions, and then you have some profit sharing contributions. All right. And so there is a total contribution amount that does apply to these 401ks or these defined contribution plans. And that total contribution amount is $69,000 for 2024. Okay. But the employee amount, the employee limit is $23,500. And if you're over 50, there's also a catch-up contribution of $7,500. So all told, you can put up to $31,000 into a 401k plan or the like. This could also be a 403b or a 457b plan. Whatever your employer situation is, that's going to dictate what kind of plan you have. But that employee contribution limit, that deadline is December 31st. So that has to be done via payroll during the calendar year of that tax filing year. So 2024 calendar year is going to catch all of those 2024, those contributions that happen in the calendar year. If you compare that to things like IRAs, like a traditional IRA or a Roth IRA or even a SEP IRA, those contributions can actually be made up until the filing deadline. Okay. And so if you're sort of on the fence, you're like, I'm not really sure what my income is going to be, my modified adjusted gross income. I'm not really sure if I can contribute to a Roth IRA straight away, or not really sure if I'm going to have to do the back door. You could delay those IRA contribution limits until the filing deadline, which for many of you will be April, with some of you will be October if you are filing an extension. And the contribution limits, for those of you that don't know this already, it's $7,000 for a traditional IRA and or Roth IRA. And that is a combined limit. So you can't do $7,000 in a traditional IRA, $7,000 in a Roth. It's one contribution limit. So really kind of pick your poison. If you're going to go traditional, go traditional. If we're going to go Roth. And then there's also a $1,000 catch-up contribution for those that are over the age of 50. Okay. So one other plan that might be applicable to some of you, especially that are self-employed, is a solo 401k versus SEP IRA. Okay. Now these rules are a little different. All right. So SEP IRA, same thing as a traditional IRA, Roth IRA. You have up until the filing deadline, and you could even delay to open the SEP IRA. Like you don't even have to have a SEP IRA open and yet in 2024. You can defer that decision until April or October or whenever you file. And then you could say, you know what, I want to do a SEP IRA contribution. And the limit there is 25% of earnings up to $45,000, which again, that equates to $69,000 total contribution max for 2024, of course, plus the catch up. And again, you can delay that decision to open that SEP IRA until the filing deadline next year. Now, the Secure Act, when that did pass, or I don't know if this was the Secure Act or the Secure Act 2.0, but it did allow for a Roth SEP IRA option. Now, I'm starting to see some plans catch on with this one. So if you want to contribute to a Roth SEP IRA, I think there are some out there that do this, but don't quote me on that. Generally speaking, I have more people that are opening up solo 401ks now relative to SEP IRAs. And so we'll talk about that here in just a second. But that's really the SEP IRA. You can either do the pre-tax or you can do the Roth, and you have until the filing deadline. And this does increase your contribution amounts relative to, let's say, a traditional IRA or a Roth IRA. So if you're self-employed and you want to contribute to one of these plans, it can potentially open the door for higher contribution limits. Now, just be aware, if you do have full-time employees on your payroll, you're also going to have to make the same percentage contribution for all of your employees. You can't discriminate against any employees in your plan. Okay. So it really works very well if you are a solo owner LLC, solo practitioner of the like. So basically a sole proprietor, sole business owner. Now the solo 401k, this has the same total defined contribution limit that I mentioned with the regular 401k. So again, that's $69,000 for 2024. And then for 2025, that limit does go up to $70,000. The catch-up contribution stayed the same. That's still $7,500 for 2024 and for 2025. Okay, so again, that's over for folks that are over the age of 50. But the difference with these plans is that you do have to open the solo 401k plan prior to the end of the year. So even if you're not making a contribution in the calendar year, you're like, you know what, I'm going to kind of kick the can until the filing deadline to sort of see what my profits were, to see how much money I can save for retirement. You can delay those contributions up until the filing deadline. Don't get confused, though, with the solo 401k. There are the three different sources. You have the employee contribution, the employer contribution, and then the profit sharing amount. So you can just sort of say, you know what? Employee contributions, yes, those payroll deductions have to happen during the calendar year, but I can make a profit sharing contribution, a one-time profit sharing contribution at the filing deadline, and that will satisfy, whatever savings amount you want to contribute to the plan. So you can just say, you know what? I'm not going to contribute anything. And then in April of next year, I'll do the full $69,000 or whatever you're eligible for whatever you're able to contribute for in 2024. Okay. So that's just important to note. It's more of a timing thing. The deadline is December 31 to open a solo 401k plan. Now, the name sort of alludes to this, but with a solo 401k, you have to be a solo practitioner. You can't have any full-time employees. You can have some part-time people, some contractors, but you cannot have any full-time employees on your payroll. Otherwise, you have to open up a regular 401k plan. And those, really it's just different testing, different costs of doing that. The solo 401k, very cost efficient in order to open these plans up these days. When I started in the industry back in 2008, 2009, really most people were doing SEP IRAs just because of the maintenance of the plan, the simplicity of it, as well as the cost. But now with these solo 401ks, how cost effective they are, a lot of my clients that are business owners, that are solo practitioners, are opening up a solo 401k. That's what I have for my business because my employees are part-time at this point in time. And so I do 100% of my contributions into my solo 401k. And I have pre-tax, I have after-tax, I even have the Roth contribution option. So what's cool is that $69,000 limit. You could say, you know what, I'm going to do employee contribution of $23,500, and I'm also going to do $23,000. Sorry, so that's the limit for $23,000 for 2024. Plus, I'm going to do $7,500 if you're over 50. So that gives you a total of $31,000 or $30,500. I think I misspoke earlier. What I meant to say was 2025 401k for the employees is $23,500. For 24, it's $23,000. But you can say, you know what, I'm going to do $30,500 into my 401k via payroll deductions. And then I'm going to match myself, let's say dollar for dollar. So now you've got, let's say you've got $55,000 into the plan with some matching contributions. Well, now you can top that off with another, let's see if my math is correct here, 75, 76, about $19,500, I believe, roughly, that you can do a profit sharing plan to hit that max contribution of $69,000. So that's really the benefit there of the 401k plan, for a solo 401k plan. It just increases those contribution limits. You don't have to have that 25% of earnings. You don't need to be earning $345,000 for 2024 in order to max those 401k contributions. The solo 401k, you can just make those contributions regardless of what your income is. But then you could also do this mega after-tax backdoor Roth conversion. Okay, has a mouthful there. And I've talked about this on the Whiteboard Fireside Chats and even podcasts before. But this allows for an after-tax contribution to be made. Okay, this is again over and above that employee limit, which you can then turn around within the plan and convert that to a Roth. So it's essentially a way, regardless of what your your modified adjusted gross income is, let's say you're phased out of the Roth, you can get that money into the after-tax portion of the 401k and have that converted. And by the way, that's not just available for solo 401ks. Many of your 401k plans also will have that option within it. Okay, so you just need to look for it. You need to look for some sort of after-tax sourcing contribution, and then the plan needs to allow for that in-plan conversion, whether that happens into the Roth 401k or converted into a Roth IRA of your own. All right, so contribution limits. I think that's pretty much everything that I wanted to talk through. Oh, HSAs, of course, health savings accounts. Now, deadlines for these also at the tax filing deadline, so you don't need to maximize all of these right away. But I will say many of you are contributing to your HSA via payroll deductions, and in order to have some matching contributions that you're eligible for. So I like to say, you know what, if you're employed and you're contributing with your employer, in terms of payroll deductions, try to max that thing out during the calendar year just to avoid complexity. But if you're self-employed, if you're contributing to an HSA outside of your plan, you have until the filing deadline, technically speaking. And the max contribution for 2024 is $8,300. Plus there's another $1,000 catch up if you're over the age of 55. Again, that is for family. If you are a self-coverage, so if you're not in a family plan, the max contribution is $4,150 for 2024, plus, of course, the $1,000 catch up. Now, a few legislative changes I want to talk through before we go on to the next topic is this concept of the super catch up. So basically, the Secure Act 2.0 that passed, it's allowed for several provisions, but one of the provisions that relates to 401k contributions and then 403b contributions, et cetera, is this idea of a super catch-up contribution. So I just mentioned the catch-up contribution for anyone over 50 is $7,500. Well, for 2025 and then going forward, if you turn either 60, 61, 62, or 63 in the calendar year, okay, then you are eligible for a super catch-up. And I believe the number, literally just texting someone about it a second ago, I believe the number is an additional $3,750. And so the total catch-up that you're eligible for 2025 is going to be $11,250. So if you add that on top of the max contribution for 2025, which is $23,500 plus $11,250, total contribution you can make into a 401k if you're, again, turning one of those ages in 2025 is $34,750. Okay. Kind of a weird rule, because then what happens when you turn 64, then it goes back to the old catch-up rules of 7,500. Literally makes no sense to me. You would think the older you get, the higher those catch-up limits should be. Not really sure who created that rule. It's just honestly one of the more confusing things in the tax code. And there are many confusing things in the tax code. Another thing was supposed to be on the chopping block, or not the chopping block, that was supposed to come into law in 2024 was this idea of Rothification of catch-up contributions. It seems like this is more likely to come in 2026 just because corporate bureaucracy at its finest. Essentially, this rule did come into effect. And so let me explain what the rule is, and then I'll tell you what's going to happen. So the rule is you can make catch-up contributions, okay? And we just talked about that. So if you're over 50, you can make catch-up contributions. Generally speaking, those catch-up contributions are going to go into the pre-tax buckets. You're going to get a tax deduction for it. Well, this specific provision in the Secure Act 2.0 is if your income is over $145,000, it doesn't matter if it's not your total taxable income for the year. My understanding is if your salary, your salaried income, the income that you show in your payroll is over $145,000, then your catch-up contributions will go to the Roth automatically. So you won't be able to deduct those contributions. They'll pay the taxes. They'll go into the Roth 401k catch-up plan. And then obviously they'll have tax-free growth, which is nice. And the income threshold, I think I just mentioned, is $145,000. So again, not really sure why that income threshold. For 2024 standards, that's not a super high income, especially if you live out in California or New York. You probably feel poor if you make $145,000 as a household. If you're trying to support a family, if you're single, different story. But it seems like that's more likely to come in effect in 2026. So probably no action needed to take on this one. And if there was action, you're going to hear about it from your HR. They're going to say Rothification of catch-up contributions. This is how it's going to impact you. But I would sort of anticipate this happening in 2026. But I think most importantly, legislatively, that I'm going to sort of make a bold prediction here is that Trump's in office. He controls the Senate. He controls the House. In 2018, when the Tax Cuts and Jobs Act came into effect, it was already written into the law that in 2026, the law was going to go back to the old levels. Okay, so this would involve the reduction in the standard deduction back to those old levels, tax brackets going up slightly for most individuals, and of course the estate exemption, the lifetime exemption, going back down to the levels prior to 2018. I think with Trump in office, I think it's very safe to say this is going to be something he wants to make permanent. I talked about that on the podcast, the Trump versus Harris tax podcast. And frankly, I made that prediction regardless of Trump or Harris won, because both of them seemed like they were in favor of extending the Tax Cuts and Jobs Act because of the benefit it has for most taxpayers. And I would say 98% of taxpayers in the US benefit from the Tax Cuts and Jobs Act. And so I see likely that getting extended. And so for those of you that have been hearing from talking heads on the media, hopefully not from me, but talking heads in the media that you need to be converting now, you need to convert in 2024, convert in 2025 because tax rates are just going to skyrocket in 2026. I'm going to make a bold prediction and just say that the Tax Cuts and Jobs Act is likely to be extended. And so therefore you probably have a little bit more time. Now, of course, if you are going under the assumption that, you know what, Kevin, I don't care what happens in office and with legislative, I just believe tax rates in general are going up over time, I want to implement Roth conversions by all means. But what I'm saying is, I don't believe you need to go absolutely bonkers in 2024 and 2025 just to assume the Tax Cuts and Jobs Act is going to sunset beginning in 2026. That's just my take. Consult your own CPA, consult your own tax advisor, financial planner, etc. If you have questions on this, let me know. Happy to chat with you on it. And I think another cool legislative event, or so to speak, that I'm seeing is this idea of the DOGE. Okay, I don't even know how you pronounce it. If it's the DOGE or the DOGE, acronym DOGE, I believe it stands for the Department of Government Efficiency. And looks like Elon Musk is going to head this up with my boy Vivek Ramaswamy. And this is really interesting. Really, what they're trying to do is cut costs within our federal government. And so I'm just really interested to see how this all plays out, because you have two outsiders that are not politicians, which is pretty much par for the course. With Trump coming in office in 2016, he was not a politician. But now he's got two individuals that are very savvy business people. Okay, you got Elon Musk, probably one of the most savvy business people in the world. And you've got Vivek Ramaswamy, who's extremely sharp. You've got these two individuals coming in, looking to shake up Washington a little bit and looking to protect our taxpayer dollars and making sure that those dollars are being spent efficiently. And I'm really interested to kind of see how that plays out long term with regards to government spending and how that has a trickle down effect to the economy. Because on one hand, the concern is, well, are they going to cut a bunch of jobs in the federal government? That's going to impact the economy. Those people are not going to find work. Elon Musk's argument is they're just going to find something more productive to do. And I just love that thought because, you think about productivity. Is the government more productive versus the private sector? That's what I want you to ask yourself and then sort of come to the conclusion of how this is going to impact the economy going forward. All right, enough on policy. Yeah, I guess the next part, strategizing withdrawals to manage tax brackets. I think this is a pretty obvious one, but, I think this really kind of dovetails into this whole pre-tax versus Roth contribution strategy. And so if you're sort of in this tax bracket, let's say you're in the 22% bracket right now, or the 24% bracket. And in 5 years, you expect your taxable income to go down because you're retired. And all of a sudden, now you're in the 0% bracket. Now you need to take income out of your portfolio in order just to get the 10% or even 12% income tax bracket. That's probably an argument to essentially do a pre-tax contribution today and maybe do a Roth conversion strategy and a distribution strategy in those early years of retirement, because you might have 5, 6, 7, 8, 9, 10 years of low taxes prior to you starting Social Security, prior to required minimum distributions kicking in. So this could be really good time at that point to take those Roth distributions or those Roth conversions in order to fill up some of those lower tax brackets. Now, conversely, let's say you're like, you know what, I'm pretty firmly planted in the 22 bracket. I don't see it really going down a ton because once I retire, I'm going to collect a pension, I'm going to start Social Security, and I'm going to need to top off those income sources with withdrawals. You know what? Maybe it makes sense for you just to simply do a Roth contribution because now you have that tax-free growth going forward as opposed to the pre-tax growth. So I think just really thinking through those tax brackets and how that's going to change for you over time is really at the core of what we're talking about for tax planning. Okay. If you have a really high tax year in 2024, maybe it makes sense for you to accelerate some deductions, whether it's charitable deductions or medical deductions, or maybe even real estate taxes. Maybe it makes sense to do that. Conversely, if you have a really low tax year, maybe it makes sense to do some Roth conversions now. Max out some of those lower brackets, the 10% bracket, the 12% bracket, maybe even the 22 or 24, depending on what bracket you were in previously, when you were deferring that income. Or maybe you're thinking, hey, you know what? State income taxes. I'm moving to Florida, moving to Tennessee, moving to a tax-free state. Maybe it makes sense for you to defer some of those taxes now while you're living in California, living in New York. And then when you retire, then you could start to generate that income via Roth conversion. So I think really the tax bracket management is at the core of what we're talking about. And so I just say, just don't miss out on opportunities. Project your tax bracket every single year. At the end of the year, that's what we're doing for clients is we're projecting out what their we're running a mock tax return for people. It's not difficult. Obviously you need some software to do, but model out some tax projections for 2024 and compare that to what you think your bracket might be in 2025, what you think your bracket might be in 2026. And ultimately where you think your brackets might go over time as you retire and you go through different phases in retirement. Now, of course, with conversions, with tax bracket management, we need to talk about required minimum distributions, which for most of you will start at 73 or at 75, okay, depending on when your year of birth. And so essentially this is the amount you're required per the IRC code that you have to take out of these tax deferred accounts, 401ks, traditional IRAs, SEP IRAs, 457Bs, TSPs, whatever your tax deferred vehicle looks like, you must start making withdrawals at that point in time. Otherwise, you get hit with a 25% tax penalty. All right. So there is a sweet spot for this Roth conversion to do that before those RMDs kick in. Because once all the RMDs kick in, it's very difficult. It might be hard to fill up the lower brackets because now you might just be in the 32% bracket or the 24% bracket straight away. And you don't have a lot of room to max out via conversion. So the conversions need to happen well before you hit that RMD age in order to really fully maximize that strategy. I think this is one of the biggest things I see my kind of the sweet spot of baby boomers that are sort of kind of in that 68 to 75 range right now. A lot of them have really felt like, man, I missed the boat on this one. I wish I started doing these conversions much earlier in retirement versus, the clients that we're working with that are in their 50s or early 60s. They're very intentional about that. They've been listening to me talk about the Roth conversions for a while. They've been reading online that these strategies, how impactful these strategies could be. But what I'd also say, Roth conversions are not for everybody. Okay. They're I would say, in our practice, it's very evenly split, 50-50 in terms of whether or not it makes sense or not. And again, I think it comes down to this idea of this lifetime tax paid and ultimately how to minimize your lifetime tax paid and ultimately taxes paid at your death by your beneficiaries. Of course, with RMDs, we should also hit on QCDs or qualified charitable distributions. This allows for you as an IRA owner, if you're over this age of 70 and a half, to donate up to $105,000 in the year of 2024, and that's going to go up to $108,000 in 2025, directly to a qualified 501c3 without paying any taxes on that distribution. So normally, a distribution from your IRA, of course, is going to be taxable. Well, if you donate it directly to a qualified charity, that's going to be excluded from your taxable income. So regardless if you're itemizing your donations or not, you can make that QCD happen. And that also reduces your RMDs dollar for dollar. So even better yet, let's say you're 73, you're making your first required minimum distribution, and let's say it's $50,000, and you're not itemizing your deductions. You're taking the standard deduction. So maybe you typically give $10,000 to charity, but this year you're like, oh man, I'm giving $10,000, but I'm not itemizing. So it's not really helping me from a tax perspective. Not so fast. Do a $10,000 QCD. That's going to reduce your RMD, your required minimum distribution, from $50,000 to $40,000. Now your taxable distribution on your IRA is only $40,000. Probably, depending on your tax bracket, it might save you $2,000, $3,000 on taxes in 2024. So think about the QCD strategy. Again, if you're charitably inclined. If you're not charitably inclined, I'm not forcing you to donate to charity. But if you are charitably inclined, and you want to also donate, let's say you're not 70 and a half yet, you can just donate cash, cash donations. You can deduct up to 60% of your adjusted gross income, or potentially deduct up to 60% of your AGI by donating cash. If you donate securities, let's say you've got some Microsoft stock or Google stock that's appreciated, you could donate that and you can deduct the full fair market value up to 30% of your adjusted gross income. All right. And so these are other ways you can sort of maximize these deductions. Is sure, you can give cash, but you can also donate securities, because otherwise, if you would have sold that Microsoft or sold that Google stock, maybe you're getting hammered with tax penalties, or not tax penalties, but with taxes. Okay. Now let's say you're doing some charitable giving, but the amount you're giving doesn't allow you to unlock those itemized deductions. Maybe you paid off your mortgage. You don't have a lot of deductions and medical bills outside of your charitable donations. And so maybe you think about this idea of bunching these charitable donations into 1 year. You can do that with what's called a donor advised fund, or a DAF. Okay. So this you open up in any custodian, Fidelity, Schwab, Vanguard. You just open up a donor advised fund, and this allows you to contribute as much money as you want into there. Now you have the same thresholds in terms of how much you can deduct, up to 60% of your AGI with cash, and then 30% for securities. But you can get those securities and get those that cash into this donor advised fund, and then unlock potentially those charitable deductions that you otherwise wouldn't have received. And maybe typically you donate the 10,000 and you say, you know what, I'm going to do 5 years of donation. So I'm going to contribute 50 grand to this DAF. Now you have this donor advised fund that you can utilize for future charitable donations on a go forward basis. And that money will continue to grow tax free. You can even invest the money, and there's no income taxes on any gains or interest income that it earns. So it almost acts like a Roth IRA for charitable giving. And then you can name a successor trustee and name a beneficiary to take over that donor advised fund when you're no longer here. So it almost could act as a multi-generational charitable giving tool for your family, which I think is pretty cool. Okay. But this could be also a nice way to parlay with Roth conversions. Let's say you're doing heavy conversions in 2024. You're like, I'm doing this for the betterment of my long-term tax play, but it's still painful. Hey, you know what? Maybe that's a good year to parlay that Roth conversion with a donor advised fund contribution to get that taxable income down. Something to consider. So I guess while we're talking about giving, we also should talk about gifting to family. So the annual exclusion per donor, per recipient is $18,000 for 2024. And then for 2025, I think it's going up to $19,000. So it's a way for you to give money out of your estate. You don't have to file any gift tax return as long as you're under that annual exclusion. If you give more, that's fine. You just have to then, I think, file Form 706. And then you're going to have to, and then that will reduce your lifetime exclusion amount, which is a pretty high amount. I think it's 13.99 million in 2025. And so it's a pretty high, very few people are going to have taxable estates going forward. And with the Tax Cuts and Jobs Act potentially or likely getting extended past 2025, I think it's very unlikely that a lot of you are going to have taxable estates now. But the annual giving could also be a way for you to sort of get that growth out of your estate, get into the hands of your beneficiaries, as opposed to maximizing how much you're leaving at your death. Okay, of course, managing IRMAA surcharges, income-related monthly adjustment amounts. I've talked about this before. I did this on a little whiteboard fireside chat on the YouTube, so check out that video. But essentially, the opportunity here is to just look at your income tax for 2024 and say, okay, hey, this 2024 tax return is what's going to impact my IRMAA surcharge in 2026. So it's a 2-year look back. For 2025, they're looking at your 2023 tax return. So just take a look at the tax return and take a look at the IRMAA surcharge brackets. If you're single versus married, it does change, in terms of what those thresholds are, but see where you are. Okay. And again, look at the video that I put together on my YouTube channel. Just Google or just do the little search in the video, or just go to the Whiteboard Fireside Chat playlist and then search for that IRMAA. Will I pay an IRMAA surcharge in 2025? I think is the video title. So just really thinking through that. And I think this also kind of parlays well into the ACA subsidies or the ACA premium tax credit. Okay. So long and the short of it, I also did a Whiteboard Fireside Chat in this in the YouTube too. So again, go to the YouTube, check that out, subscribe to the channel. But essentially, if you are between 100% and 400% of the federal poverty line and you retire before 65, you're going to need to get some health care. And it's very likely you're going to end up on one of the state exchange programs. Well, with those ACA health insurance policies, you could potentially be eligible for some pretty generous premium tax credits depending on what your modified adjusted gross income is. Okay. So there's a special calculation that's specifically related to the ACA subsidy. But even if you're over 400% of the poverty line, you still could qualify for premium tax credit depending on what the total premium is as it relates to your total adjusted gross income. So I think just kind of thinking through that and like looking at, okay, how does this Roth conversion, again, if you're retiring early, how does this Roth conversion or this capital gain distribution impact my modified adjusted gross income? And then how does that impact my premium tax credits? All right, I've got to also talk about asset location. Very simply put, what assets do you own where? If you have a taxable brokerage account, I guess the way I'd put this, own the tax efficient investments there in the taxable brokerage account because they're tax efficient, and own the tax inefficient investments in your IRAs, in your 401ks, in your Roth accounts, okay? And so, investments that pay a large capital gain distribution every year, probably shouldn't own that in a brokerage account, okay? Investments that are super high in interest income or just cash flowing type of investments, probably want to own that inside of an IRA or 401k to reduce that income, which ultimately impacts your IRMAA surcharges, impacts your tax brackets, and of course, impacts your ACA premium subsidies. So just thinking through asset location, what investments are you owning where? All right, we pretty much hit on a lot of these. Now of course, there's a lot of others here, in terms of entrepreneurs, business owners. I'm thinking in terms of my own tax planning, there's a lot of things that I'm doing for my own business to keep my taxable income down. For you, PFR Nation, I think this will hopefully be a nice little starting point in terms of thinking through end of year tax planning tips. If you have any questions on this at all, drop me a note in or a comment in the YouTube channel. Send me an email, kevin@imaginefinancialsecurity.com. Go to my website. Happy to answer any questions you might have. And if you're interested in working with me one-on-one, we are currently accepting clients in the first quarter of 2025. I think we might have one slot left. I do need to confirm that. So tentatively, I'm saying we have one slot left. Potentially, that might really be open in terms of the second quarter of 2025. But if you're interested in working with me one-on-one, just fill out that retirement readiness link in the survey in the link in the show notes and just answer some basic questions. You don't even have to share any personally identifiable information, but just share some basic information and I'll follow up with a personalized Zoom recording of myself reviewing that information and sharing with you some specific opportunities that I see if we were to work one-on-one together. So that's it. And of course, make sure to share this with a friend or family member. It is Thanksgiving, right? So if you've got someone that in your circle of friends or your family members that's a PFR Nation type of person, share this podcast with them. Say, hey, you know what? Here's some tax planning tips for the end of the year. Listen to this. Let me know what you think. Because really, ultimately, that helps us reach more people. It helps us trick the algorithm to help more people and impact more people, which is what we're trying to do here in this podcast. So, and of course, this is not tax advice. This is not legal advice. Consult your own legal professionals, consult your own advisors before you make any changes. But with that being said, happy Thanksgiving, everybody. And until next time, this is Kevin Lau signing off.